If you are 55 or older, then you are going to want to watch this. In this video, Alden Armstrong, our head of product, and I are going to discuss every key way that you can use life insurance to protect your wealth, pass down your wealth, create a legacy, and make an impact while all at the same time growing it. And if you aren't 55 or older, you may want to stay tuned, as these principles and strategies can or will apply to you at some point. Now, some of you watching may be thinking, life insurance at my age? I am way too old for it to make sense for me now. And I understand where you're coming from, but we are here to crush those limiting beliefs. There's an old proverb out there that states, the best time to plant a tree was 20 years ago, but the next best time is today. This could not be more prevalent in this scenario. We're going to show you 5 strategies with a bonus strategy at the end, where if you have built any wealth over the last few decades, then there's a strategy for you to leave more, grow more, and protect it all at the same time. If you're older than 55 and are not able to save at least 20K per year and or have any available liquid assets to preserve and protect, then there is an extremely high likelihood that the strategies that we are discussing here today are not for you. But that does not mean one day it can't be. It all starts with education, and that's why you are here. So with that being said, let us dive in. The first strategy that we are going to discuss is the cash flow strategy. And then to piggyback on top of that, we're going to talk about the front load strategy. And so the cash flow strategy, you can see our screen is shared, is going to be a strategy where somebody has cash flow coming in. And this is specifically designed for somebody the age of 55 or older. And this illustration specifically is showing somebody the age of 65 years old. So when we're looking at the strategy, it is going to be of somebody that is still in the phase of income is coming in because they have constant cash flow to be able to distribute to this concept. And just when you're looking at this numbers, we have $100,000 going into this contract every single year, but this does not have to be law of $100,000 has to go into it. If for somebody of 55 or older, what we would want to say is a minimum of about $20,000 per year is a good number for you to conceptually think about what makes sense to have from a cash flow perspective. And so this is specifically for example purposes to be able to conceptually get a point across on how this cash flow strategy works. And so when we're looking at this illustration, we have $100,000 going into it, and we have a bunch of columns here that I know that may seem like a bunch of numbers and can cause a little bit of confusion. But what we're going to do is we're going to focus on 3 specific columns. We're going to focus on the total premium that's going into the contract. Okay. And then what we're going to focus on is the cash value. And then the third column is we're going to focus on the death benefit. Okay. So when we're looking at this contract, we have $100,000 per year going into the contract. And you can actually see that here, premium outlay, $100,000. And then you can see here the total cumulative outlay that we've put into it. So you see it goes up by 100,000 every single year, 300, 400, 500, so on and so forth. And then we have the total cash value. And this cash value column here is why a lot of you may be interested in this concept. Here at the end asset, powered by better wealth, we really want to optimize a lot of our illustrations to be specific for the person that comes to us for their goal. So we first start with like, why are we here and what is it that we're trying to accomplish? And a lot of times the goal can be liquidity, control, use of these funds. Well, it's a dual purpose to be able to have a death benefit at the same exact time for our families to pass down from a legacy perspective. And so if you're 55 or older, have cash flow that's still coming in, you maybe still be working, you have cash flow from assets that are coming through, and you value still control and wanting to build wealth, but also value passing down a legacy and a death benefit to your loved ones, family, church, anything and anyone that you find of significance in your life. Well, this is an incredible strategy specifically for you. And so what we're looking at here is a policy that is designed for that control, liquidity, use. It is a place to storage of capital to be able to use for whatever specific use you would like in life. Now, with the and asset, we really have a philosophy that we want to use our policy specifically for asset producing activities, right? That doesn't mean that you're forced and locked into using it for an asset specific activity, but that is a goal of ours, because when we're using these policies and we're using the funds, the cash flow column, we are borrowing against our policy. Our cash value is being used as collateral, And the insurance company is going to give us a loan to be able to utilize these funds and have control over it. And so, with that being said, there is a control cost, and that control cost will vary per year and per the state of the economy. And so, when we're doing so, we a lot of the times want to use this policy for an activity that is a greater return than what we're borrowing at, a greater result than what we're borrowing at. And so, when we focus specifically on the asset, if we were to say borrow at 5 or 6%, getting an asset that's cash flowing or that's getting a greater return that's greater than 5 or 6% is going to be important when it comes to the philosophy of the and asset. Now, when I share that the philosophy is using it for an asset producing activity, it can still be used for other things such as emergencies, other opportunities. We've had clients that have used this for vacations, expenses. We've had it for people to use for mission trips, taking a trip to help you rejuvenate as a individual, to show up better as a human, to make a better results for you and your family. And so when we're looking at this design, we're going to focus strictly on cash flow first. And then what we're going to do after that is we're going to then talk about the death benefit. So first, $100,000 going in the contract. We have about 65% liquidity in the very first year to use. Now you may be able to ask yourself, like, hey, like, why is $35,000 not available to use? And that's because there's a lot of factors that get involved to this. There's commission to the agent. There's a death benefit that we're, being provided at the same time. There's cost of doing business to the insurance company. There's all of these factors that go into it. But at the same time, we have to remember that this is a long-term thinking. I know you may be thinking, well, I'm 55, 65, like I may not have a ton of time, but I would imagine that if you're able to qualify for life insurance, you're very youthful and have the right mindset, or else you wouldn't be looking at this channel and wouldn't be looking at this video of this being something specific for you. And so when we're looking at this contract, we can see the growth on this contract, and we can see the change in cash value growth. So year one, $64,000, 351, and then the growth change in the total cash value growth is 78,000. This column here, as we've been paused here for a little bit, you can kind of see what the number is. Feel free to pause the video if you want to see how this grows. And you can actually see here kind of the difference in the amount from the amount you contribute to the actual growth. And so what ends up happening in year 5, you actually contribute 100,000 and it actually grows by 7,833. And so what we're going to do in this video later is Alden's actually going to show you some policies, potentially if you don't qualify for this, if you're not able to get this specific from a health purpose because you may be sick, you may have health issues. We have other solutions. So stay tuned, because later on in the video, there's going to be other options for you as well. And so this is for somebody that is healthy, that wants to provide a death benefit to their family, specifically that has cash flow, all the things we talked about, that can do at least $20,000 per year. And so when we're looking at this from a break-even perspective, and just to reiterate on what break-even means that I have more cash available or equal to cash, the same cash available than what I've contributed to the policy. And so that number specifically happens here in year 9, where I've contributed 900,000 and have 923,977 of actual liquidity and use of funds to be able to use. And at the same exact time, we have $2 million of a death benefit to be able to have and pass down to our family. And so again, this is an incredible tool to be able to have our dollars grow and control while we have a death benefit to pass down. And what we're going to see in some of these other contracts that Alden is going to share, that there may be some more efficiencies when it comes to somebody maybe younger. And that's kind of the thing that we have to understand, is that when you get insurance younger, it's obviously going to be better, but that doesn't mean that this contract still is not a great solution for you, your goals, and your family, and what it is you're trying to accomplish. And so, Alden, I don't know if you have anything specific that you want to add to this, but before we talk about maybe the front load strategy, but this gives us a baseline of the and asset and how it can be specific on a basic perspective for you, that's somebody 55 and older.
Amazing. Yeah, it's perfect explanation so far, Dom. A couple little tidbits that I'm going to add here. When we are talking about life insurance and the and asset, we start the process on anybody who wants this concept as young as 4 weeks old. This is one of our youngest clients. Also working with clients who are in their 80s, getting life insurance on themselves. So the concept works kind of regardless of where you are in your age, the question you have to ask yourself is this the best place in the use of my dollars for the goal that I'm trying to get at? Right. So if the answer is yes, let's have a dialogue. And if you're not sure, then schedule a call. We can talk through it. This particular policy design that Dom has here, we're maximizing the cash value. And you'll notice if you've seen some of our other illustrations and different videos on this channel and our other channel, the immediate efficiency of the policy is affected because we're on a 65-year-old instead of a 30-year-old. So that's a big factor. But at the same time, the growth in the policy and how we build it is exactly the same. So you'll notice down here, if you highlight year 13 and 14, Dom, we have premium that was going in $100,000 a year for 13, 14 years. What's happening when that premium starts to drop and it goes to 87, and it goes down, that goes back up, and it goes down again. This is the software trying to prevent the contract from becoming a modified endowment contract. So what I'm saying is we're putting so much cash into this thing and we're trying to make it as efficient as possible. The software with the insurance company is fighting back to make sure we don't make it taxable, which is a good thing. It's a good indicator that we're building the policy the right way. So I just wanted to highlight that. And then the second part, this policy has a base premium of about $25,000. We also have a flexible protection rider built into that as well to supplement some additional death benefit. If you look at the dividend, after 7 years of funding this policy, your policy technically could become self-sustaining because your dividend is now larger than the minimum cost of insurance on the base policy. So there's a lot of flexibility in the way that we build these. And one of our goals at Better Wealth and the way that we build policies is to give you long-term options. So I've said enough about this particular design. I'd love to dive into the front load as well, Dom.
Amazing. And just so everybody watching, Alden is head of product and case design. And so he is our wizard on the team. And so he talks very technical from a life insurance perspective. And so I am the fifth grader that's here to learn and also try to speak in layman's terms a lot of the times. And so when it comes to a modified endowment contract, just so everybody understands what that is, it's essentially the IRS, putting a limit on the amount of premium that could go into a contract based off of the amount of death benefit. And if you put in too much premium based off of the death benefit, well, then that taxable event kicks in. And so when we're using these contracts, we have the ability to access this cash, this tax-free, and the death benefit also gets passed on tax-free as well. So there's tons of tax advantages when we're talking about this contract. And so it's an incredible asset that's giving us multi-purpose, multi-use. And then when we talk about the base contract that Alden was talking about, how the dividend can essentially pay for your base piece of it, in this contract, there's lots of flexibility in payments. And so what he's saying is that the base is the minimum required that you have to pay every single year. With the flexible protection rider, which we won't get too into depth what that even means, but we'll just lump that all into the base contract, which is the minimum amount. It's roughly around 25,000, maybe just a little bit more than that. But it's roughly that is what you're committing to every single year, and you have to. Worst case scenario, we can have the dividend pay for it. But best case scenario, we overfund, which is that extra 75-ish thousand, which goes directly to our cash value, which is what makes this special than typical whole life insurance that someone may see in usual financial planning, or why individuals like Dave Ramsey may not be a huge fan of whole life insurance as a place to store capital. And so with that being said, all the incredible explanation, and we will move into the next strategy, which we deem as the front load strategy. And so when we're looking at the front load strategy, in my opinion, is a great strategy for people that have a combination of two things. One, a large lump sum of money that's sitting around that's being idolized that needs to be better used than sitting somewhere like a bank account that they want to now start getting growth on it. And somebody also that still values the death benefit for their family. But with the front load strategy, you still have to make the ongoing payment, just like we looked at the cash flow strategy. So it's taking a large lump sum of money, putting it in the first year, and then combining the cash flow strategy that we just talked about. And after that year one, this just turns into a cash flow strategy at the end of the day. But what this does is it supercharges the policy, and it essentially makes the policy extremely powerful, because when you put a ton of money in right away, it has the power to grow faster than it would if you put in less money. That's just a simple equation of compounding interest. It's a factor of interest, time, and the amount of capital going into it. And the more capital that we put into it, the better it'll perform most of the time. There's always caveats to everything. And really, it comes down to how we design and the person we're designing it for. And so specifically, this design is showing $500,000 a year going into the contract. And so here it is here. And then you have the cumulative premium in this column. And what we're doing is $100,000 therefore going afterwards. So you'll see it goes 500, 600, 7, so on and so forth. And you also see that there's two sides here, a lot more numbers on this one than maybe even the last one. We have the guaranteed side over here and a non-guaranteed side over here. And so a lot of the objective of this video is to really try to give you a really deep dive into the and asset and these policies and give you a whole entire information conceptually on what it is we're talking about. And so in whole life insurance, there's guarantees built into it that regardless of what happens, the insurance company contractually is buying to pay this out as long as you make your premium payment. The beautiful part about this is when we use the right company specific for this strategy, that is a mutual carrier. So you are essentially an owner of the company when you purchase a policy versus a stock carrier where they put the interest in the vested interest of the stockholders, right? When we use a mutual carrier, you now get the dividends to you and your policy versus the dividends going to the stockholders. So this is why it's very important that we make sure we choose the right company and it's designed appropriately at the same exact time. Because Alden did talk about a little bit about the dividends, paying for your premium, your base premium portion of it as time goes on. But if you use a company that doesn't have a dividend, then that is not a factor. And in my opinion, using overfunded whole life insurance or whole life in general without a dividend, it's not a very attractive place to store money whatsoever at all. And so with that being said, we are going to take a look at the non-guaranteed side. Again, this is not guaranteed, which means that the insurance company will pay a dividend based off the profit of the insurance company. But these insurance companies that we've used have been around for 110 to 170 years, and they have never missed a dividend payment ever. And so even though they're not guaranteed, they are pretty close to guaranteed, at least from a history perspective. And so it's not anything that we have to worry about of them paying. They've essentially been through pandemics, wars, the worst financial scenarios in the U.S. history. And so when we're looking at these contracts, we're going to focus on the non-guaranteed because they are paying dividends and they've never missed one. And it's what makes the concept special. And so when we're looking at it, we'll stay our eyes focused on this right side, but know that there is a guaranteed piece of it that's built into it as well. And so year one, when we're looking at this contract, we've contributed $500,000 and we have $452,000 of liquidity available. To me, that's an extremely powerful concept because I now have redistributed a large lump sum of money into a policy where I have liquidity and control and use. And I've also bought a large amount of death benefit for my family. In this example, it's $4,655,000, at least for the first year. And you'll see that it drops off after the first 7 years to $1,747,000. And we'll talk a little bit about that in a second. But this is what gives us the dual utility where we now have control and use over the money. While it's compounding, we also have the death benefit of use to be able to have there for protection for our family as well. And so when we're looking at this contract, the increase in premium relative to the last contract, and I think we could actually even go back and look. So this is year two, $91,000 of growth for $100,000 put into it. And then on year four, you put in 100 and you have 100,996. So if we go back to the other contract, it actually happens year five, I think is when it happens. Yeah. So it happens slightly earlier in this contract to be able to have more dollars being growing than we're actually contributing to the policy. So that is another example of why a front load could be super attractive. And to be honest with you, for people that are younger, the younger you are, I think this strategy specifically is actually a little bit more advantageous. The strategy that Alden and I are going to share with you next, I think is actually a more advantageous strategy for an individual that has a large lump sum of money that's sitting around that they wanted to redistribute to this concept. But this just gives you an idea of what is possible. And this is really good for people that are maybe still real estate investors, business owners, entrepreneurs that have that headspace of wanting to still control and borrow against and use for other activities at this stage in life. If you are more so in a settled down stage, you're not in a real growth stage, well, then we have another strategy that I do think next that it will likely be a little bit more advantageous for someone specific. And again, that's why it's important that you talk to somebody that can ask great questions, figure out what it is you're trying to accomplish, because we want to make sure that we design the contract specifically for you based off of your goals and not just put you into a cookie cutter one size fits all. And so with this contract specifically, the break even point we talked about, we have the same amount of cash than what we contributed. Happens at year, looks like year 8 is what it is. 1,180,000 has been contributed. $1,198,000 dollars available for liquidity. Now, this happens 1 year earlier as well, relative to the last contract that we looked at. So you could look at from an efficiency perspective, this contract is performing better, but also we have to remember we're putting in $400,000 more into the very first year. And majority of that is paid up additions, which is the cash injection that we're talking about, which makes this concept super sexy. And so I will leave it right there from that perspective. And Alden, I don't know if you have anything you want to add to this, or specifically, maybe you want to talk a little bit about why the death benefit drops off a little bit, but this is the front load strategy relative to the cash flow strategy.
So I'll add on and just comment on that. The way we can justify getting in a large amount of premium that first year is by buying supplemental term insurance and adding it to the policy. So that's giving, from the IRS perspective that Dom described before, it's giving us room to shove in all that extra cash. Now the IRS looks at a 7-year time frame, and so what we've done here is we've taken that death benefit out and maintained a high death benefit for 7 years. But once we don't need the high death benefit anymore, because now we're outside of the 7-year time frame, we just knock it off, and that's why you see a drop in the premium as well. So this strategy, as Dom mentioned, this may not be ideal for somebody over the age of 55, 60, 70, 80. It's an option, but what we're going to dive into next, I think, could be a better fit for quite a few people that are going to be watching this episode. So we'll look at that in a moment.
Amazing. And again, just to reiterate, when you start to see the numbers drop from 80 to 25, just like Alden shared in the last video, this is essentially the cash flow strategy after year 1. So if you need a little refresher on what that looks like or what that concept is or what's happening, just know that we can change the design of this if we wanted to. By technicality, we could probably make this number 100,000 for a little bit longer if we wanted to. But what we're doing here, essentially, like Alden has talked about, is we're dropping the term cost as early as possible, knowing it is strictly a cost to the policy. And that's why the death benefit drops off so much from year 7 to 8, is because here we have what's called a 7-year term rider, and that is strictly an expense. Once that expense gets dropped off, we no longer pay for it, which is, in this scenario, it's about a $20,000 cost. If you were younger, this would be a whole lot cheaper, which was also buying us roughly around $4 million of death benefit. And so our goal is to maximize the cash, which is why we drop that off as early as possible in this specific scenario. And so with that being said, I think this is a great pivot to then go into the next strategy. And the next strategy is what we call a PDF/SPIA strategy, where it takes the front load design and the cash flow and morphs them into one. And I personally think that this is probably, in my mind, for this age specific group of 55 and older, is probably the most powerful strategy that nobody really is discussing and talking about, as there is a little bit more moving pieces, and you have to have the right companies and really have to know how to design it and really have to know what you're doing to make this work. And so with that being said, Alden is going to take it from here to get this conversation started about this. Technically, we'll call it the second strategy. We're going to put the cash flow strategy and the front load strategy into one strategy, knowing that they're relatively the same. So our second strategy being our PDF/SPIA strategy, we're going to dive into now.
Perfect. So a brief overview of what we're trying to accomplish here. When we're taking a large sum of cash and putting into a front load strategy, as you can see, we're incurring a lot of costs, right? We have to justify a lot of premium going in the very first year. And then on top of that, we have to pay consistently moving forward to maintain the performance of the policy. So what Dom alluded to is that there's effectively a way to blend both of these strategies to make it very efficient. I'm going to describe it effectively by talking about two separate buckets. So the first bucket, we're going to take a dollar amount. And in this example, we're using round numbers. We're taking $1 million dollar amount and put it into a single bucket. This bucket technically isn't life insurance. What it is we have the total amount of dollars coming into this strategy, and it's going to earn a guaranteed rate of return for a set period of time. Now, this is an example of a premium deposit fund. So this is a fund held at the insurance company that's specifically designed to hold future premium payments. We also use another vehicle for this called a single premium immediate annuity. The SPIA is what we call that in layman's terms, or in abbreviated terms. A SPIA operates the exact same way. Depending upon where interest rates are in the environment of the economy, PDF or a SPIA may be better suited. There's also some different protection benefits with a SPIA that you don't have with a PDF. But to be very specific here, what we have is a first bucket growing at a guaranteed rate of return, and this is illustrated at 5%. Very first year, put in $1 million. And what's happening is every year, imagine a door at the bottom of that bucket. You open the door and then you shut it. That's going to let out a certain amount of, in this example, money that goes into something else. So this is a annual premium that's being diverted from the first bucket into the second bucket every single year for 10 years. And you'll notice that that premium number remains the same the entire time. So when we start talking about why this could make sense, we talked about the benefits of a front load, talked about the benefits of cash flow strategy. So the second thing that I want to show you is we're taking this particular bucket and we're funneling it into a secondary policy. Now, this secondary policy, you can see the premium payments the first 10 years, $123,338 every single year for a 10-year period. After 10 years, no additional premiums are due. So by you contributing a certain amount of money, and it obviously doesn't have to be $1 million. This is a number that we get fairly routinely with people who have money they want to reposition. So this is why we use that round number in the strategy. So we're repositioning an asset amount, and it's going to pay into life insurance policy on the individual. So we can see this is a 66-year-old male paying in for 10 years. And one of the cool things in the way that we structure this is you've put in a total of $1 million into the first bucket, but because that bucket is growing, sending money over to the second bucket, which is whole life insurance, and that bucket is growing. Over the period of 10 years, you've put in a total of $1 million, but your total net cash value is 1.34 million. And so you're getting two places of growth in the same strategy, which I think is really, really powerful. Mm-hmm. So what are the downsides? Well, with a front load strategy, if you put a lot of that into a front load, you'd have a high degree of liquidity. But a downside is all of a sudden you got to pay future premiums, right? In this strategy, all of your premiums are paid for, they're taken care of, and you're effectively repositioning one of your assets and putting it into a policy where it's safe, protected under state law. Predators, creditors, and lawsuits can't get after it, right? In addition to that, it's the tax benefits, right? It's the tax efficiency, as well as purchasing a permanent death benefit. One of the questions I get asked that I want to address very quickly is, let's say we die in year 5. So this individual dies at age 70. Well, you still have a whole lot of money in the premium deposit fund, and you've paid a lot of money into the life insurance policy. What do you get as a death benefit? Effectively, you get the death benefit of the life insurance policy, and you get a return of the asset that's in the premium deposit fund. Or if it's a SPIA, it's the same kind of concept. So in this scenario, we're maximizing two different financial vehicles to allow some positive synergy to happen between them. And so this is a very scalable concept, whether it's a dollar amount change, an age change. We can do this on individuals very young, very old, all across the gamut, as we said before. So Dom, I want to just pause for a second. Do you have any questions that you'd like me to clarify about the strategy, or any comments yourself?
Yeah, so it sounds like from a strategical standpoint, in one sentence, you have a large lump sum of money that's sitting in a side account getting 5% growth. And every single year, that account then funnels and pay for your insurance premiums, correct?
Exactly.
And then in this example, that has created an additional $233,000 that is going into this contract that you wouldn't have before because that's above $1 million, correct?
Correct.
Amazing. And then what are the tax implications in regards to the PDF, the side account?
Yeah. So one of the reasons that we use a SPIA or a PDF is because of that guaranteed rate. You can deploy your money, you know it's going to grow, and a contractual guarantee. And because of where interest rates are, PDFs and SPIAs can range from high 4% all the way up to 6%. This is illustrated at 5. So those gains, because they're outside of life insurance, it's like any other type of investment. You're going to be taxed on the gain when it happens. Once it's in the life insurance policy, you've gotten an extra $233,000 in the policy over the course of a decade. The policy has continued to grow. And so you have now 1.3 or $1,345,000 in the policy after a set period of time. And then we just turn off funding. So all the additional change in cash value markers here and all the growth the policy has experienced outside of what happened in the premium deposit fund or that SPIA is now growing in a tax deferred manner within the policy. And the way we get to it and utilize it is tax free. That's why there's always some confusion between, I thought you said it was tax free, tax deferred. The answer is yes. And everything in life insurance, everything in finance it depends on how you use it. And so the way that we teach it allows the money to grow tax free and you can access it tax free long term.
Amazing. But since the money that's in the side account is not technically in life insurance, it doesn't get the same tax benefits, correct? So that
Correct.
$233,000 that is grew by, that $233,000 is taxed at our taxable income, correct? Do we get a 1099 at the end of the year for it?
Correct. Either from the insurance company holding the premium deposit fund or based on your SPIA contract. Now with SPIAs, they can kind of adjust the taxable burden and spread it out over a different time frame. PDF, you're taxed on basically $23,000 a year of additional gain.
Oh, amazing. Another question that get asked often is this money that's inside this PDF side account, is that accessible? Like what happens if like a worst case scenario emergency happens and I need that money? Is it locked up? Is it tied away or do I still have access to it?
Very good question, Dom. So the premium deposit fund with the majority of the companies that we work with is liquid. And so when we have it locked in there, it's growing at that set rate. If you absolutely need access to it, you can do one of two things. One, hey, insurance company, give me my money back, and they'll cut you a check or send you a wire, right? Because it's your dollars and you're just surrendering the contract. The other way is we work with some third-party lenders who are able to lend against the premium deposit fund at certain carriers. So effectively, you can get those dollars and use them either by surrendering it or by leveraging against this, just like we do for life insurance. There's pros and cons to each of those, obviously, depending upon where rates are. But understand, if we use a premium deposit fund, you do and can have access to those dollars again.
It's amazing. And then in this example, you mentioned that the rate for the side account, PDF account is 5%. Is that
Yeah.
locked in or does that change?
So it's 5% for the life of the contract. So the
Amazing.
premium deposit fund contract or the SPIA contract, it's a set period of time, and you get that growth for that set period of time. If rates go up, you're locked in down here. If rates go down, you're locked in up here. So it just depends on where rates are as far as if it's a good decision to surrender and reallocate. But again, that's why you work with an advisor who can talk you through the overall economy and the environment.
It's amazing. You know, a lot of the times people will say, well, why would I, put money into this in this example when I could put it into a high yield savings account or something like that? Well, the answer is why not get all, right? I have an account where I can put it in, get 5% growth that's guaranteed because it's locked in, and then it redistributes it to another account that's also going to grow and compound. And I have access and control of that. And I now get tax benefits because whether it's in a savings account or it's in this PDF account, you're going to have to pay taxes. But when it's in life insurance, you no longer have to pay taxes when it's used properly and designed properly. And at the same exact time, we have a death benefit for our family to be able to pass down from a legacy perspective. And along the way, we don't have to think about making ongoing premium payments because the contract is already doing it for myself. And worst case, if I need anything, I can still have access to the full amount of money for whatever emergency that I need. Honestly, this
Yeah.
is when you start talking about it out loud, like, this is why I think this strategy is such a profound strategy, because it hits all the buckets for something from risk management, growth, protection, liquidity, use, and a pass down of the generational wealth to be able to give funds to the people that you love and you care about. Absolutely incredible. I love it.
Yep. Absolutely.
So I
That,
think that would make sense, unless you have anything else all then to share, would be kind of go on to the next strategy.
yeah, let's rock and roll it. I think the last thing that I'll mention is because we have no additional premium outlay in this policy design strategy, it doesn't mean your cash value and your death benefit stop growing. All right, because of the mutual insurance company we're working with, that dividend that comes back into the policy continues to grow and continues to compound everything that you're seeing here. So this
I
this
love it.
continues to take off over time.
I love it. Amazing. So that is strategy number 2. That's what we call the PDF/SPIA strategy. And again, somebody on the team, everybody that you'll talk to is super specialized, and you talk to a strategist in regards to designing these, and we'll make sure that if it's something that you want, it makes sense for you, to get you the most ideal contract for you in your specific situation. And so for strategy number 3 of 5, what we are going to talk about now is what we call a single pay strategy. The single pay strategy, you may have heard, or what we sometimes tone it as, is a CD alternative. And
Yeah.
so in certain environments, it's definitely a no-brainer, because CD rates in the past have essentially been very low, 1%, less than 1%. Obviously, CD rates currently, when we're watching this video, is February, or when we're creating this video, excuse me, is February of 2024. And so if you're watching this a year from now, 2 years from now, interest rates may be different. And that is perfectly okay. The beautiful part about life insurance is that things are consistent with the guarantees, but based off of the interest rate environment, it'll also perform. And so higher interest rate environments, these policies actually do perform better, because the insurance companies are investing into a lot of the same things that provide some of the higher rates when the interest rates are also higher as well, such as bonds and so on and so forth. So I'm going to share my screen again, and I'm going to share a strategy that we call a single pay. And this will actually be a strategy that we'll be able to gloss over faster than the other strategies, because there's not as much to it, but it still can be a very profound strategy for the right type of person. And so what we have essentially done in this scenario is done the same thing that Alden did in the last strategy. We've taken $1 million and we have redistributed it into this contract. And what this contract essentially does is it allows us to have a death benefit that is higher than the amount that we put into it right away, to redistribute wealth to the next generation right off the bat, never having to think about it ever again. So if you're somebody that has $1 million that's sitting around, and your number one focus is passing down generational wealth right away and really nothing else, now there is other uses for it, but that is the main specific use of it. Well, this is an incredible strategy, because you can say, hey, I'm going to pass down $1 million to X in your family. There could be tax benefit or tax situations you have to deal with when it comes to gifting. You're not going to be able to get the same amount of dollars passed down that you would in this scenario. And so what I mean by that is, we've contributed $1 million to this contract, and you'll see that there's zero going forth. There's no more money going into this contract, but you have instantly $1,387,000 of death benefit, legacy, increase wealth instantly transferred over to the next generation. So versus keeping it in the savings account, you have $387,000 that's passed down tax free. That is the other beautiful piece. You have more money and it's passed down tax free. Now, this contract is a modified endowment contract that Alden and I were talking about a little bit earlier in the video, which essentially means that you don't get the same tax favors that we talked about in the previous strategies. And so what that essentially means is it's now taxed as something like a retirement account, something very simple from that perspective. The growth on the contract, when you want to use, you have to pay taxes on the delta. So everything that you've contributed up to your basis, you get to use tax-free. So in this scenario, $1 million. And then anything above that, you now have to pay taxes on it. So let's just even go to like year 2. You put in $1 million and there's $15,000 of growth. If you use $15,000 of in this contract, you now have to pay taxes on that $15,000 at your current taxable rate. This also does, from a MEC perspective, operates like a typical retirement account as well. So if you're earlier than the age of 59 and a half, so to reiterate, this is not from somebody that's 55 to 59 and a half, even though we talked about this whole entire strategies as a whole is for people older than 55. If you're in that 4-age window, this isn't for you specifically either, because you will have to pay a 10% penalty before 59 and a half if you wanted to access any of the money. And so that's just also something to consider, is that there is that 10% penalty, but once you're 59 and a half, you no longer have to pay that 10% penalty, but the taxes are still the same. In the previous strategies, we talked about using our dollars, such as borrowing against. And this strategy, if we wanted to use it, we would take a simple withdrawal and not use it as a loan function, because regardless, we're already paying taxes and it's already a MECTA contract. So there's no reason to have a loan interest on charge on top of having to also have a taxable event, kind of double dipping in the negative way. But again, this contract specifically isn't for control, liquidity, and use, but it is there if needed. That's the beautiful part. Again, the and asset is beautiful because it allows our dollars to do multiple things. And what I mean by that is it has multi-purposes. We have a generational wealth passed down of 1.3 million, and it grows. It does not ever stop growing as time goes on too. So the longer you live, the more wealth you'll pass down without having to do anything, and knowing you have the safety, secure guarantees built into it. The market goes south, the market tanks. This is a redistribution of money that you know is safe to pass down to the people that you love. And at the same time, this net cash value here is going to continue to grow as well from a use if you need it for any purpose. Alden, I don't know if you have anything else to add to it, but I feel in my world, from thinking about it, this is kind of where the only thing that I have to say, because in my mind's a little simpler than some of the other strategies.
Yeah, the only thing I would add to this, Dom, is interestingly enough, we're doing $1 million of premium, right? And this policy is going in the first year, which is going to make it a taxable MEC contract that we talked about. The policy we just looked at using the premium deposit fund, it's $1 million going in the first year. We're just spreading out the premiums because we're using that secondary bucket that I talked about. So if you pause the video, go back and look at the other illustration, your cash value and your death benefits are going to be pretty darn similar compared to these two policies. The biggest difference is going to be the tax consequence. Now, the previous illustration does perform better long term, and there's other reasons for that. But I thought that was kind of interesting, and I wanted to point it out.
Yeah, that is. And the last thing actually that is very interesting in regards to this is we looked at the increase in net cash value and some of the other ones. If you look at this contract, you're putting no more money into this ever again. Year 2, you put in $0, but your contract grew by $43,732. It's incredible that you can just set it aside knowing that you have strong growth rate with a death benefit without putting any more money. If you were to do the math, you could say easy, okay, 4.3%, 4.5%, 4.7. The longer you live, and you could, and technically, because you only put $1 million, saying like year to year, you might even get to 9.7% growth if you're actually looking at it per year on the amount of money versus what you put into it. So it can be a pretty profound strategy for the right person. It's a very small group of people that it's right for, but it definitely is a very great strategy if it makes sense for you.
Yep.
And so with that being said, I think going into strategy number 4 of 5, talking about multi-generational planning would be the next best step. And so Alden, with that being said, let you take it from here.
Amazing. So we've danced around this concept of, hey, you're older, and this is the video audience, right? You're older, you're looking at life insurance, maybe you want to use it as an asset or a strategy for your family. Now, if you're, for some reason, you can't get insurance, or you want to do multiple strategies, maybe get a policy on yourself and then something on somebody else, we do have the ability to get generational policies. So I'm going to use 3 terms here. Generation 3 is going to be grandkids. Generation 2, your kids. Generation 1, the OGs, that's you. So when we're talking about this from a planning perspective, we have the ability to get policies on yourself, second generation, and the third generation. So this first one that I'm looking at here is going to be multi-generation policy, and this is specifically to the second generation. So we have $50,000 going in, and just to be clear here, guys, there's 3 different policies that we're looking at here. These first 3 columns, all the way down, and our editing team are going to bracket these for you so you can see the difference. I'm running it a comparison. So it's the same concept. We're buying an insurance policy on a 35-year-old son, and we're choosing to pay into the policy for 10 years. I built these 3 different illustrations and threw them up here as a comparison because depending upon what you're trying to accomplish, we have the ability to customize the policy design to you. Now, one of the really unique things here is regardless, if you look at this first year premium, you have cash value. The difference is going to be the amount of initial death benefit. Continue to look at that all the way across, right? Same thing on the far right here. Each one of these policies, a point that Dom brought up earlier, is a break-even point. Well, Alden, I thought if I buy more death benefit, it's going to affect my break-even point. Not if you're working with a guru. So we have team members that work through these on a daily basis. And effectively what we're doing is we're compressing the life insurance contract. Instead of being able to pay it for age 100, which is typical whole life insurance is paid to age 100, we're paying it for a set period of time. So we're taking that payment period and we're squishing it down really, really tight. So what that does is it's going to accelerate the cash value growth. This first policy, we're technically buying more death benefit, but our break-even point is year 6. You put in $50,000 for 6 years, $300,000. Break-even point is year 6. This middle column, similar concept, but now we're putting a little bit more money toward paid-up additions. So our cash value is going to grow a little bit quicker, a little bit less death benefit. Break-even point is still year 6. And finally, on the far right-hand side, again, same idea. You're putting in $50,000, but this is for somebody who might want a higher amount of cash value initially, and they're okay with that small drop in death benefit. Now, because we're putting more dollars toward paid-up additions, and in some other videos we've talked about, paid-up additions is that extra premium bucket that's technically buying more life insurance every single year. So what you'll see is your death benefit grows quicker on this far right-hand policy. But after 10 years, if you stop paying, you're effectively shrink wrapping the death benefit. Across all three of these, those cash value numbers and total net death benefit are very, very similar. The growth long-term across all columns are very, very similar. So the question is, Alden, why would I want one of these policies instead of one of the other ones? I illustrate to you this because going to any traditional financial planner or an insurance person, if you tell them you want to pay for 10 years, the typical policy that they're going to sell you is a traditional 10 pay, meaning you can pay for 10 years and that's it. You have no option to pay for a longer period of time because you didn't ask for it. This far right policy is the one that we most often go to. There's a couple of reasons for it. One, you get higher cash value initially. 2, after 10 years of premium payments, the reason the death benefit drops is because the insurance company is actually expecting you to pay more premium long term. This is a true pay to 100 product on the far right hand side. So what that means in layman's terms for you is this gives you options. We don't know where your finances are going to be in 10 years. Now, hopefully they're going to be in a very, very good position. And you may want to continue to fund this for that second generation, for your son in this example, 35-year-old. And so this type of policy gives you the option to continue to pay years 11, 12, 13, 14, or you can also transfer ownership of the policy and give it either at your death or before that, tapping into your lifetime gift exemption and transfer the value of the policy to your son in this case, allowing him to continue to fund and maintain a higher degree of coverage. So lots of things that I just went over there. Dom, you're the king of asking clarifying questions here. Anything that I missed or you want to highlight?
Yeah. So just to get clarity around the owner, the insured, and the payer. So when we're looking at the insured is the individual in this instance who's around 35 years old because it's your kid for the individual we're speaking to. But
Right.
they who we're speaking to is the owner, which means that they still have full control, right? Of like
Control.
the cash and how they want to use it, right?
Exactly.
Amazing. And then the death benefit will essentially get paid out likely to who in this scenario?
So if you individual we're speaking to here, this is your son, you're the owner of the contract, you're paying the premiums. You have the ability to elect a beneficiary. In most cases, that's going to be yourself, your spouse, or a trust. Now, you're likely going to predecease your son, just by statistics. So that death benefit, if he predeceases you, comes to you. But if you predecease him, you can transfer a beneficiary through means of a will, through means of a trust. And ultimately, if this person, this son, ultimately owns the policy after your passing, they can elect their own beneficiary as well. So it's a way for you to protect an aspect of your estate while you're alive, still have access to it. And upon your death, transfer that to the next generation in a very efficient manner, allowing them to continue to fund the policy if they so choose, to continue to maintain that permanent death benefit and continue to grow it over time.
That's so good. This is why I love this concept because you talked about the multi-generational planning. And what this essentially does is it allows you to truly create and keep wealth inside of the family for generations to on and on end, right? Um,
Yep.
when when this person essentially dies and passes, if you're no longer the beneficiary likely be the next generation, which would be generation uh, three in that example, correct? And therefore,
Correct.
they now have a bucket of money that they can then start another policy on themselves, and so on and so forth. If there wasn't already a policy on them, which I think we're going to go into next, correct?
Correct. Now
Amazing.
there's some nuance to all of this. Obviously, these are broad stroke examples. But one of the things we have to understand is anytime you're involving family for legacy planning, we can pass back and forth money between generations. Passing back values is much more difficult. And so we
Mm,
partner with a couple of estate planning firms that allow us to partner with our clients to make sure that the life insurance and the estate plan, the values that you're transferring between generations are aligned. So
mm,
that's something for another conversation. But for this policy design, one of the things we have to understand as well is if your son doesn't have a good relationship with you or doesn't want you to own a life insurance policy on them, it's not happening because he's got to get the medical exam. He's got to get
mm,
everything approved. And also most insurance companies, actually all the ones that I know of that we work with, require that he owns his own life insurance as well. Because remember, you're the beneficiary and you're getting a policy on him. But he has to own his own insurance because if you're going to get insurance on him, he has to show value in his kids as well in that next generation. So if he doesn't have any insurance, this is a much longer conversation that needs to be had. So lots of things to consider. But reach out. We can talk through the specifics. I'm going to
amazing.
pivot
I
into
love that.
the next policy design for the
Let's
grandkids. Does
do
that
it.
work, Tom?
It's
Okay.
beautiful.
Pivoting into this next conversation, this is going to be a policy on that third generation we talked about. So you as the owner, we've talked about insuring the middle, right? The generation two. And we have to have some kind of insurance either with you and them or just on them to be able to qualify to get insurance on the third generation. That's a requirement with every company. So we have in this example, I've got a 5-year-old and a 14-year-old. Both of these policies we're going to be paying into them until they graduate college. So age 22 approximately. For a 5-year-old, we're maximizing that cash value, right? So every single year you put more dollars into this in the same concept of all the other videos that we talk about. You've got a growing death benefit, you've got that growing cash value. And 17 years into the policy, so now he's going to be 22 years old, he's got $123,000 available to him. So just for conversation's sake, and we have no idea where inflation is going, but is this going to be enough to perhaps pay back some of the student loans you borrowed? Or another great way to do this is allow the policy to fund college or to start a business and have the policy be the repayment vehicle instead of some government agency or some private agency collecting interest. It's another
Mm,
concept of how you can use the policy as a bank for your family.
mm,
This one here is same concept, putting in that $5,000 per year on a 14-year-old kid. So they're going to turn 22 a lot quicker. So the policy on the right here, this is going to be for a 14-year-old. So I've got the same payment time frame. It's that $5,000 per year for a period of time. And oftentimes people come to me and they want to ask, like, how do I make this equitable, right? Well, in the left-hand side, he's going to be 22 years old and graduating college. In the right-hand side, they start at age 14. You've been paying it for 17 years, so the kid's going to be in his 30s. But regardless, you've put the same amount of premium into the policy. And the very cool thing, in my opinion, when it comes to juvenile policies in most of these companies, the cost difference is very, very small. You're under the age of
mm,
18. The difference between a 2-year-old and a 17-year-old is very minimal in the cost of insurance because they're rated as a juvenile. And so what that means is your cash value on both of these policies is pretty darn close. That's a $500 difference in 17 years, given the assumption of the dividend. And so this type of strategy allows you as an individual who perhaps can't qualify for your own insurance, you can get insurance on your kids and insure their kids as well. That process, qualification is a whole other story. And as I said, we have to have family buy-in to make the process work. But this allows you to continue to perpetuate your wealth in your family, your legacy, and your values across 3 generations, because the beneficiaries of this policy that you're setting up for your 5-year-old is going to be somebody almost 100 years from now if they live to life expectancy. That's a huge generational impact that a lot of people get
mm.
very, very excited about. So Dom, this strategy is kind of wrapping up here. There's not any other bells or whistles beside this. So we're just looking at who else can I insure? And so to kind of sum up everything, first generation is you. Second generation is going to be your directest descendants, your kids. If your kids are adults and they don't have kids of their own, it's hard to get insurance. If they do have kids, we can make the argument that you want to pass down additional legacy to your grandkids. So we can insure that second generation. The third generation, we can also get insurance on if that second generation has their own insurance. So as you can see, there's aspects of insurance planning that get complex, but conceptually, you're just getting insurance on somebody else. You still control it. You're in charge, and your wishes, how you do your will, your trust, your estate planning, can carry out the ultimate beneficiary and the cash use of these policies long term.
It's amazing. And I think it's important, even though we're designing these a lot of the times for cash specific focus, for control, liquidity use, for whatever and whoever, the insurance company is not necessarily looking at it from that perspective. They're looking at it from a business, and which is why they care about the death benefit and who's receiving it, and why that there's so much intentional planning around it. And luckily, we have an entire team on the back end that's helping with a lot of this to move you through the process to see if you qualify, from the strategists to the underwriters, across the board. We know the people inside of these insurance companies to help get these moved across the goal line as well if needed. And just to reiterate, Alden, if you are the first generation and you want to get it on the third generation, the middle generation still needs to have insurance as well, correct?
Correct.
Amazing. And so, yeah, I think this is an incredible strategy for if you want to just give even a gift to, that generation, to your grandkids. A lot of the time people want to set up 529s because they think that it's a great strategy for them to use down the road for them while they're alive. And while a 529, one could argue, has gotten better, especially with the new rule where if they no longer want to go to college, you actually can use it to roll over to an IRA. What this strategy does allow you to do is allows you to keep the tax advantages, right? All of the tax advantages we talked about in the previous ones you get, and they have a death benefit to pass on to their family when they're older, to be able to have the legacy. But this here gives you options. You're not stuck into one bucket of I've got to use it for school or I've got to use it for X.
Yeah.
They can use this for a down payment on a home. They can use it for real estate, to start a business. They can use it for a wedding. They could literally use it for whatever they want to when you decide to gift it to them or borrow against to then gift them that in that way, right? So there's lots of ways that it can go about it, which is why this concept is amazing, because it's profound the longer you have it. There's guarantees built in, and it gives options for the future, because who knows where college is going to be, 10 years from now, 5 years from now, right? And a lot of people, depending on who you ask, are starting to wake up to college is a world that is over cost more than the value that's provided in a lot of educations, in a lot of systems, unless there's a very specific cause, such as like wanting to be a doctor, a lawyer, so on and so forth. So therefore, it makes college as even a smaller bucket for the person who should go, and the should is in the value that they're paying for the value that's provided after they graduate.
Yeah.
So
amazing.
Wow. Jinx, you owe me a Coke. Love that. All right. So in regards to this strategy, Alden, I think you're correct. We can definitely wrap this one up, and we're going to go into the fifth and final option strategy before we dive into the bonus section. And so with the fifth one, let's talk about some estate planning.
Amazing. So disclaimer, throughout this video, we've mentioned the concept of estate planning, wills, trusts, etc. a couple of times. Dom and I are not tax professionals. We are not attorneys. So we have people that we refer people to for this type of planning. What I'm going to talk about now is the concept of using what's called a second to die or a survivorship policy to protect your estate from future estate tax burden. So in layman's terms, right now, the estate tax level in the United States is set at a certain mark. That mark is going to effectively sunset. So what that means is, right now, if you're a married couple, if your estate value is $27 approximate $million, it's like $27.2 million, you're exempt from taxes on your estate if you die and your estate is processed before the sunset. So when the sunset happens, it's going to be beginning of 2016, we go into new rates. That exemption amount drops for married couples, dropping to 14.
Just to reiterate, Alden meant 2026, not 2016, but that's okay.
Oh, thanks for that.
Yeah.
Yeah, so 2026. I don't have a time machine here. So effectively, that exemption of your estate value is going to go down. And so what that means for a lot of people, let's say you have a moderate sized estate right now, you're 55 years old, you're worth $10 million. You've got another 30 to 40 years to continue to compound and build upon what you've built.
Hmm.
So in all likelihood, you're going to end up in the future to where when you pass, you and your spouse pass, the value of your estate is going to be above that exemption mark. So what I'm illustrating for you here is a second to die policy looking to buy an amount of death benefit that's going to help you pay your taxes in the future on your estate. So if you're above that exemption mark, you're paying somewhere between 18 to 40% on your estate value after it's processed. That can be a lot of money for a lot of people. So we use this kind of concept to buy a permanent death benefit that will grow over time, hopefully growing with your estate value or at least with inflation. And then upon your death, transfer and pay those taxes. So right off the bat here, some of you may have noticed a dirty word, IUL. So we have a lot of conversations about this on our channel. And one of the things that we've become much, much better at the length of time that we've been in the industry is we're becoming more product agnostic. What I mean by that is every product in the industry, in the finance industry, is there for a reason, for a person, and for a purpose. And so when we understand that, there are ways and reasons to use certain policies. So for example, you'll notice this policy on the left here is buying $2.5 million of death benefit. And this is on a 65-year-old male and a 60-year-old woman. So it's linked together. Policy on the right, it's whole life, buying the same amount of death benefit. Look at the difference in premiums. Whole life insurance, because it puts a lot of risk on the insurance company to produce dividends and to maintain guarantees, it's going to cost more, but you have more security in it. We can get a cheaper policy with a similar death benefit with an indexed universal life policy. Now, there are certain companies that provide what's called a non-lapse guarantee, which means regardless of the performance of the policy, because IULs are linked to indexes in the stock market, we're quoting this one, just so you understand, at 6%, which is very reasonable. We've seen illustrations at 10 and 12, which is terrifying. But quoting it at 6%, this is giving our policy a growth rate over time. And we're assuming it's going to grow at 6% per year. Anybody who's been around the block a couple of times knows the stock market doesn't do the same thing 2 years in a row, period. So what this does is it's going to protect your downside in some sense. If the market does really, really poorly, your death benefit is still guaranteed at the purchase price of 2.5 million. The growth we're seeing in here is predicated on the growth of 6% per year, which also is driving up the cash value. So I say that to illustrate for you, we can use different products for different people depending upon your concept of risk and your beliefs in the stock market and your beliefs in the economy. So if you come to me for an example and you say, hey, I want a second to die policy, I've got state tax to look into in the future. A no lapse guarantee IUL could make a whole lot of sense. But what you don't see in this illustration is IULs often have surrender charges. So you may have cash value out here in year 10, but you could also have 15 years worth of surrender charges, meaning if you have a surrender charge, you can access a portion of the cash value because they're holding a portion back in reserve in case you cancel the policy. Whole life insurance doesn't have that at all. So you have a higher degree of access, albeit a lower growth rate and a lower death benefit projected growth rate, but you have more access and more control. So we can use both of these types of things for estate planning to help cover the future cost of the possible taxation of your estate if you fall into the estate tax territory.
I think that what Alden is specifically saying too is that when we start talking about estate planning, this is where things get a little bit more complex. This is not the normal type of conversations that we'd have with 99% of people. This is for people that are extremely wealthy, that even in this scenario are likely wanting to contribute even more money than this. But what this does is gives a really conceptual good idea of how this would work, right? Because he talked about it's above $26 million of that number currently. Obviously, with the sunset, that can change or will change. But this strategy is for a unicorn, but a very powerful unicorn when the time is right. And so when we're even looking at the IUL This isn't a strategy where it's like, hey, like we would do this for a lot of clients. This is like
Yeah,
1% of the clients that this makes sense for. And working with a specialist and a strategist and an expert, and then working with an attorney that's also a strategist and expert, really diving in that
absolutely.
this type of strategy is right for you, as this is not right for 99% of people that we work with. But we definitely wanted to make sure that we shared this because we didn't feel like we would do justice if we didn't share the options that are out there, especially for the individual who we're speaking to on this video too.
Absolutely. To Dom's point, we partner with a lot of estate planning firms. And depending upon your needs coming into the call, coming into our ecosystem, we're effectively going to evaluate you to figure out who best to connect you with to help you achieve your goals. Now, if you have an estate planning team, talk to them about life insurance. If you're concerned about a future estate tax, talk to them about life insurance. Now, when you need somebody to do the life insurance, I don't know a single attorney that sells life insurance. So give me a call and we can have that conversation. But if you don't have anything in place and you want something in place, you can still contact us. We can talk through preliminaries and ultimately connect you with people that have been in this industry providing estate tax structuring, or sorry, estate planning and structuring for close to 40 years. So we've got the contacts and resources to serve you at a very high level. This is just an example of how we protect your future estate value and your family from future taxation.
Amazing. I love it. So to summarize, we talked about 5 different strategies. Okay, the first strategy was the cash flow slash front load strategy. The second strategy was what we call the PDF slash SPIA strategy. The third one was the single pay. The fourth was multi-generational planning. And then the fifth was estate planning. And now what we're going to do to wrap this video up is we're going to give a little bonus. The bonus section is going to be a conversation on another powerful tool for a very specific individual. This individual fits into the bucket for who we're talking to. For really people that are 60 and older, this anybody that's younger than 59 and a half, this strategy is likely for. And then there is some other strategies that could fall in line that make sense for maybe somebody specifically a little older. Like we talked about in the PDF strategy, we use what we call a SPIA. A SPIA is an annuity. And what we're going to do now is in this bonus section is we're going to talk about annuities and who it's for, what they're trying to accomplish, some of the pros and cons that this specifically may be a use case for. And so with that
Yeah.
said, Alden, do you want to kind of start us off and then I'll be able to tag team and go from there?
Yeah. So just very basically, what is an annuity contract? It's still a private contract with sometimes an insurance company, sometimes a finance company, and they're providing some aspect of value. Most of the time, that's going to be in an incremental, guaranteed, or assumption growth of your dollars. So, for example, the SPIA that Dom talked about, if you took $1 million or $100,000, put it into a SPIA, we can pick a time frame, whether it's 5, 10, 15, 20 years, where you're going to receive income payments immediately off of the amount of money you put into that product. So there's a lot of nuance and variability to what we can do here. We can do it for a set period. We can do it for your entire life. You can do it for the entire life for yourself and your spouse. So it's also considered as an alternate pension plan. If you're concerned about your other cash flow situation upon you exiting a job, you're stepping into retirement, and you want an aspect of your portfolio to have guaranteed income, a SPIA can be a fantastic opportunity for that. There's other types of annuities that we talk about as well. One of the big things that a lot of our wealthier clients are talking about is, Alden, I'm less concerned about the death benefit. At the moment, I'm more concerned about losing what I've had, because for most people, we have stock market assets. And over the life of 60, 70 years, you've seen this go on a lot. If you were around in the dot-com bubble, you saw your 401ks become 201ks. So the concern for a lot of people is not having money when they need it in retirement. So one of the products that we can use in this situation is called a fixed indexed annuity. Effectively, same concept as before. You give a lump sum to an institution. They take those dollars and they invest them into indexes. Now, because of the product wrapping of an annuity, they have guarantees, meaning depending upon the contract, your growth is bottomed, meaning it can't go below 1 or 2%. Sometimes it's 0%. So if the stock market does negative 10, the $100,000 you put in there might earn 0 or might earn 1, depending upon your contract. So it eliminates the risk of loss. Now, conversely, the stock market does 40% and you're in the annuity in the index, oftentimes your gains are capped somewhere between 7 to 15%, depending upon the contract and carrier. There's other benefits as well, but the big thing for a lot of our clients is we take a bucketized strategy, meaning if you've got all of your money sitting in the stock market, that's all volatile, that's all very liquid. And there's some concern there because if we have another dot-com bubble, another COVID, your entire portfolio crashes. And if you pull and draw from a crashed portfolio, you're compounding the loss. So if we take sections and re-diversify, still tie it to the asset class of your interest, which in this case is stocks, we can maintain a growth rate in an upward trajectory, even when the economy is going the other direction.
Mm. No, this is good. So there's the concept of going up the mountain and down the mountain, right? And up the mountain is wealth creation, building, growing. And then coming down the mountain is I'm at the peak where I've created my wealth. I now want to effectively distribute it. And I want to distribute it in the most efficient manner with the least amount of risk. And this is where an annuity then comes into play. And there's people that have done well research on it, such as like Dr. Wade Pfau, that has an entire book on retirement planning that talks about how powerful an annuity can be in regards to coming down the mountain. And like Alden said, there's two specific types of annuities depending on what your goals are and what you're trying to accomplish. And for guaranteed income annuities, the older you are, the more income that actually will provide per year, maybe not over a long period of time, because it is really insurance at the end of the day. So if you had $1 million and you try to get an annuity at age 90, the insurance company is going to pay out more per year than if you had $1 million and you were essentially 40 years old, right? And the reason is because there's a lot of times, and I'll correct me if I'm wrong, is if you put $1 million into an annuity and you happen to die, well, then the money just kind of goes to the insurance company at that point in time. Now, I think there are annuities where there are death benefits or there are riders or things like that that can ensure that you do get certain money back and you just may get less income through that process. And this is why talking to a specialist, I am not an annuity specialist. I know just enough to be dangerous. And then when it comes to the fixed index annuity side, really the rate of return really isn't going to vary or change based off of your age because it's going to, be based off of how the index performs. And then on those scenarios, there are surrender charges that can be involved with it within like the first few years. It's not as liquid as something like a life insurance contract. When it comes to taxes, there are taxes that are having to be paid on the growth of it. And so the strategy is a super powerful strategy to preserve wealth and come down the mountain. There are small nuances to make sure that we're aware of and educated around that doesn't say, hey, this is the best product in the world. But as long as we're educated and know how it works and how it performs, well, then we can say, hey, this tool is going to be a great resource for what it is that we're trying to accomplish. And that is where we're trying to, at the And Asset Powered by Better Wealth, is get into the headspace of educating the consumer that all these products that we've heard of in the past, whole life insurance, annuities, reverse mortgages will fall into this bucket, that they're all just terrible, bad products. And really what it comes down to is designed, used improperly, and not educated in the right context can create a very terrible product. All the products that I just mentioned, they have gotten people in a lot of trouble. They've lost a lot of money. It's caused a lot of headaches and pains for their family. But on the flip side, if set up and used properly and structured with the right advisor, these strategies and products can change people's lives from a generational perspective, safety, risk, and peace of mind perspective. So that's why it's super important that you just make sure that whatever you choose to do, that you make sure you understand what it is you're getting into and you're talking to the right person to set these things up for you.
Amazing. Thanks, Dom. So effectively what we're talking about here is distribution planning. And we have an entire arm of our company that focuses on distribution planning. So if you've reached that point in your life where now you're looking at your assets, you're trying to figure out, okay, how do I make these work for me so I can continue to live the life I want and pass them on to the next generation? It might be worth the time for a phone call.
Amazing. So if you're watching this video and you feel like one of these essentially 6 strategies, the first 5 or the bonus is for you, use the link that's provided. Reach out to the person that sent you this, connect with somebody on the team that can help you. We're more than happy at the And Asset Powered by Better Wealth to make sure that you're set up properly with whatever your desired result is.